Welcome back. You're watching First Rate right here on ET Now. We have the management of Indian Bank joining us right now. Binod Kumar, who's the MD and CEO of the bank, is joining us this morning. Thank you so much, sir, for joining us on ET Now. And let's begin first with the loan book growth. It was a tad bit below your own expectations of about 11 to 13%. This was actually dragged by corporate advances growth that was just about 3% on a year-on-year basis. So what's your outlook now there? And with this trade uncertainty, do you think that the corporate growth will remain subdued?
No, see, basically last year corporate credit growth has been subdued because we said some around 10 to 12,000 crore of the low yielding advances. Because of that, it is subdued. Otherwise, if you see my growth in RAM sector is around 14% overall, 13.7%. And this time we are targeting a growth of around 9 to 10% in the corporate book. And we have given guidance of 10 to 12% for the next year. And we are seeing some good demand in few of the sectors like renewable energy, EV, smart metering, CGD. So we are seeing some good demand, and also I expect more focused or more capex from the government side, because last year because of the in Q1 capex growth was not there as much as expected, which will not be the case this year. I expect there will be good demand in corporate, and we'll be able to achieve guidance of 10 to 12%.
Let's talk about your deposit growth, because that also missed your own estimates. It grew only by about 7%, and within deposit, it was largely led by term deposit, which was higher by about 11%. Do you think that it will be largely be led by term deposit in FY26 as well, if you talk about the deposit growth?
See, deposit growth guidance we have given of 8 to 10%, we could have achieved. But see, we have to see where it is making more sense. So we raised around 10,000 crore of infrastructure bond, which is more beneficial to us when we talk of the cost of it. And similarly, we have also taken some refinance, which is cost effective. That's why we didn't go for the very aggressive deposit. And if you see my bulk growth in bulk has remained, it was 1.01 to almost 1.06. So bulk, we have not taken any bulk deposit. So similar strategy we will also adopt this year. Having said that, there will be a stress on the CASA. Although we have maintained CASA percentage of 40%, but going forward, even maintaining 40% will be challenged. And growth in CASA will also be a challenge.
All right, so that brings me to the next question then. Why do you think there will be a difficulty in gaining your CASA ratio, especially now that RBI is pushing liquidity in the system?
Customer preferences are changing. Financial literacy has increased. And there are many opportunities, alternate opportunities are available. Where they can earn better margin as compared to the maintaining in CASA. So CASA, few of the funds, even up to a few months back, a lot money there was a continuous increase in SIP, MF, etc. Even individuals, if you see the demat account opening, number was increasing quarter on quarter. So that is customer preference is changing, and also government is also moving towards JIT. So that will also be one of the factors for the CASA, subdued growth in CASA.
Right. Your credit costs, although remained well within the guidance for FY25, that saw an uptick this quarter as well. For our viewers, if you could help us understand what actually led to this phenomenon, and also how should one look at your credit costs and slippage ratios going ahead?
Yeah. Slippage ratio has remained within our comfortable range. It in the traditionally also or historically also, if you see during Q4 in March, some MOC etc. Auditors go branches, they pass some MOC. Because of that only, my slippage has gone little up, because otherwise, other than MOC, it has remained within our targeted zone. And for next year also, I am giving guidance of slippage ratio of less than 1%. And one data I would like to share with you. If I talk of the stress in SMA 012, I'm happy to share that my SMA book, which was 15.59% at the end of the financial year 24, it has come down to 8.006% for the financial year 20, at the end of the financial year 25. So we have taken many measures. Because of this, we have been able to achieve this number.
Right, and your board has actually approved the equity to raise equity of about 5,000 crore rupees this year. You have a very healthy CET1 ratio of about 15.7% or so. So if you could help us understand what's the rationale behind this equity fundraise, how are you looking to utilize it, any timeline that you can help us?
We have taken approval to see our capital adequacy ratio is at 17.94%. So normally we will not require to raise, but if it's the right opportunity comes, for that enabling, we have taken this approval. Even last year we had approval of similar approval of 5,000 crore for the equity raise, but we have not gone for the raise of the equity. But enabling clause, we have taken approval for enabling that if we get some good opportunity is there, we are getting good price, then we may go for the capital raise.
All right, sir, we leave it there then. Thank you so much for joining us in ET Now to talk about the quarter gone by for Indian Bank, being candid and open about the way how you've performed and what you're expecting going ahead. So that's the management of Indian